Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. A 3-week market sell-off intensified on Monday, with investors worried that tariff policy uncertainty would tip the economy into a recession, something President Donald Trump did not rule out over the weekend in an interview. We're going to dive into the rest of today's market trends. Then for-profit education company Adtalem has seen its stock surge by nearly 80% in the last year. We'll sit down with its CEO to discuss that growth and how the current administration could impact its plans. Plus, we're going to hear from the CEO of the American Petroleum Institute on what tariff uncertainty means for the oil industry and where gas prices could be headed in 2025. Well, U.S. stocks selling off in today's trade, with the Dow sinking over 800 points and the NASDAQ logging its worst day since 2022. Yahoo Finance's Blikre joining us now with the trading day takeaways. Jared.
Thank you. There's really no other word but meltdown. That's what we saw today. It's not panic selling, but it was not good. And this is the S&P 500. This is a 6-month chart. I'll put some lines on here. You can see it a little bit better. We are basically back to September levels. So this entire area here, that includes the post-election gains, all of that is just now erased. NASDAQ composite, arguably looking about the same, if not a little bit worse. That's actually, you'd have to stretch that back more than 6 months. And then if you take a look at some of the sector action and what's going on under the hood, we just took a look at this at the bell, but worth reiterating, XLK, XLY, that's consumer discretionary and tech, down over 3% each. And let me go back to this. Let me go back to the charts. I have something prepared, which is the mega cap losses of the day. And here you can see Apple, that is down $182 billion. NVIDIA down $139 billion. Tesla down $130 billion. That return, they were down about 14% today. That was the worst return since the pandemic. You have to go all the way back to 2020. So this is not nothing. It's not a complete disaster, but it is not nothing.
So you're calling out some mega caps here.
Yeah.
What about the small caps, Jared? The pint-sized
Oh,
players?
so Russell 2000 had its worst day since last Monday. So that was only a week. That's not too bad.
Yeah.
But ARK Innovation Fund, that's kind of small cap tech and unprofitable tech, worst day since August 4th, 2023. So actually, June 13th, 2022. So kind of the point is we're not seeing much growth on the horizon here, at least in the short term.
All right.
That brings me to the second point here, seasonal weakness. So we do a lot of work with seasonality here. I've shown this VIX chart. I'm going to update this. We had a lot of work to do. I'm going to update this in real time. It's up to here right now, somewhere in there. But you're going to see that almost imminently, according to the seasonal map, that's just historical tendencies, we tend to roll over. So that's kind of the good news, is that we're kind of possibly finding that bottom. Now, that's VIX seasonality. This is stock market, S&P 500 seasonality. And I got two lines here, and not to confuse everything too much. The one that I think really holds the best is the white line, but that has not so far come to pass. You see, that was supposed to go up and then come down. That has not happened. So that was since 1928. The green line is since 1990. And this would be where we're bottoming right now. So the best news is that we just kind of turn up and head higher into the end of the month. But problem is, once you get a big down day like this, there does tend to be continuation.
When do things tend to turn up?
For all of my seasonality maps get better in April. So right now, admittedly, this is muddy and things are kind of messy right now, but things get better for the most part in April. And that's just a backdrop. That seasonality is history, accounts for about 1/3 of price action, but 2/3 is reality. What we have to deal with in the present moment. All right. Guess what? Crypto crash.
I knew we were headed. Yeah,
crypto crash. We got to check out what Bitcoin is doing. Only a week or two ago, I believe I said I had a 70,000, 70 to 72,000 target.
This very segment, I believe you called that out, 70,000.
Yes, sir. And let me show you the 1-year chart here. There we go. So we had this big topping formation, and well, you don't know if it's a top until you go down, but we do know now. And my point at the time was, you got to look to all this price action in here. There's a lot of price memory, and that can act as a floor itself. But see, there's still at 10,000. That's actually $10,000 right in there. There is a gap. And then I had a Fibonacci extension. Probably don't have time to get into what exactly that is, but that points a target all the way down here to 72,000. So 70 to 72,000, I think, is where we see some major buying step in. We're just not quite there yet.
What about, quickly, that was Bitcoin. What about the other tokens?
Ethereum, this looks pretty bad. I think we're at the lowest levels since going back to 2023, late 2023. Not quite as bad as a huge 2022 bear market, but just a lot of choppiness in here. And let me show you what's happened over the trailing month in all of these crypto tokens. I'm going to sort from best to worst, and you're going to see a lot of these guys are down 1/5, 1/4%, and Ethereum, for instance, down 30%, and that's just over the last month. So a lot of selling here today.
Red everywhere. Thank you, Jared. Appreciate it. Well, an entire industry has emerged to address the problem of rising education costs, offering consumers alternatives to traditional education paths, such as four-year colleges. One of those companies, Adtalem Global Education, has seen its stock climb by nearly 80% in the past year. Now, however, Trump administration has made abolishing the Department of Education a priority, forcing the industry to pivot. Joining us now is Steve Beard, Adtalem Global Education CEO. Steve, it is good to see you. So let's start right there, Steve, because President Trump, we know, in his targets, he's got the Department of Education. He talks about wanting to close it, Steve. I obviously would assume that's on your radar. You're monitoring it. What does it mean, Steve? What could it mean for your business?
Well, it remains to be seen. Great to be with you this afternoon. We are the country's largest healthcare educator, providing opportunities for a wide variety of students to pursue clinical careers. The Department of Education is an important agency, but as we understand the administration's plans, they largely intend to move some of the core activities of the department to other federal agencies. And if that's the case, I think we'll all adapt to facing off against other agencies in the administration. We believe that the federal student aid programs that our students rely upon will endure, and that programs like the Pell Grant that so many students rely on will endure. So we wait more details from the administration, but we think our business will be fine, and that higher education as a category will be fine, whatever happens to the department.
Even if the department stays open, though, Steve, is there a possibility we could see cuts in terms of federally funded loans and grants?
Well, we know that the administration is looking for cost savings, and one place they may look is federal student aid programs. We've implored both our stakeholders on the Hill and in the administration to not diminish the opportunities for students to finance their education. So our expectation is that the availability of federal student loans will continue no matter what changes come to the U.S. Department of Education.
You know, Steve, I would assume, maybe a lot of investors might have bet that if Republicans control the White House, Senate, and House, they would assume, okay, that's going to mean a lighter regulatory backdrop, a lighter regulatory footprint. And that would be good for your industry and for-profit schools like you run. How do you think about that dynamic?
Look, I think it would be good for higher education broadly defined, but certainly for our industry and our business specifically. We look forward to launching more programs that we think are responsive to the market need. We look forward to expanding existing programs in ways that allow us to bring more well-trained clinicians to U.S. healthcare, which so desperately needs those clinicians. So the opportunity to grow our programs and grow our business in a friendlier regulatory environment is something we're excited about, and we look forward to partnering with the department to do just that.
You know, we saw a sell-off today in the market, Steve, and clearly some investors are concerned Trump tariffs and government firings could really sink this economy. I'm kind of wondering if there was a slowdown in the economy, is that actually kind of a tailwind for a company like yours, that people think, okay, if the economy's slowing, if a job's harder to get, hey, option B, I'll go back to school?
Yeah, so I think for education as a category, an economic slowdown is a net positive. People tend to retool in economic downturns, and that's good for higher ed, broadly defined. What I would say about us is because we're healthcare focused, that cycle doesn't necessarily apply to us. The secular demand trends for healthcare workers endures in any economic cycle. And so for us, boom or bust, from the broader economy's perspective, we stand to gain because the demand for our graduates is so great.
Steve, great to have you on the show today. Thanks so much for your time and for joining us. Appreciate it.
Pleasure's mine. Thank you.
All right, we've got breaking news here from Delta. The company now lowering its first quarter guidance and now sees total revenue growth for the first quarter of 3 to 4%, compared to the same time a year ago. That is down from growth of 7 to 9%. Companies saying the outlook was affected by the declines in corporate and consumer confidence, which is leading to a, quote, softness in domestic demand. That stock is sliding roughly 9% on that news and taking down shares of other airlines as well. All week long, Yahoo Finance will be providing in-depth coverage and interviews with leading Wall Street experts from S&P Global's annual CERAWeek Energy Conference. On the other side of the break, we are joined by American Petroleum Institute CEO Mike Summers. You won't want to miss that. Stick around. Much more Asking for a Trend right on the other side.
Oil prices continuing to slide today on growth concerns. This is the biggest names in the oil and gas industry gather at S&P's CERAWeek Energy Conference in Houston. Joining us now, Mike Summers, CEO of the American Petroleum Institute, which represents the industry. So, Mike, thank you so much for joining us from there. We really appreciate it. So it's an interesting backdrop for the conference, right? We saw oil settle, WTI that is settled today, below $66 a barrel. There do seem to be a lot of growth concerns out there. So I'm curious what you're hearing from your members and what you're hearing on the ground there at the conference about some of these growth concerns.
Well, one of the key themes that is emerging at this year's conference is truly that we're going to need a lot more energy, particularly to feed the AI and data center boom that we know exists and that's going to continue to grow. So one of the themes that we continue to hear from our members is we need a lot more energy going forward. And what that means is that we're going to need a lot more oil and gas in particular. So I think the growth story is going to be enormous for the oil and gas industry going forward.
You know, when it comes to more oil specifically, as we well know, the administration and President Trump's mantra of drill, baby, drill that he has repeated here, how willing are your members, though, to increase production when we've got oil prices that continue to fall here?
Our industry is poised to grow significantly this year. In fact, based on just what we're hearing from our membership, we expect about $200 billion in investment in the United States just this year alone. The world is going to require $600 billion of investment just to keep oil production at its current rate. So we expect continued growth here in the United States. We reflect on some of the numbers that we've seen out of the Dallas Fed that says that 57% of oil executives expect growth this year. So we expect continued growth in these markets, particularly on the natural gas side as well, which we're going to need a lot more of if we're going to supply the needs of the world, an energy-hungry world that continues to grow.
Right, definitely natural gas playing an important part. Oil specifically, though, we're at just about at record production here in the U.S. Are we going to see an increase in oil production specifically this year?
We are close to 13.5 million barrels of production a day. That is record levels. And I expect that, based on the independent analysts that we've seen, the Energy Information Agency at the Department of Energy actually expects that we're going to grow that by the end of the decade to almost 15 million barrels a day. And that's good for the United States, that's good for American consumers, but it's also good for our world partners as well, because we know that that growth is only going to go up. The world consumes about 100 million barrels of oil every single day. That number is going up, not down, and that means more investment here in the United States and across the world.
I think if I heard you correctly on those numbers, that is still less than a 3 million barrel a day increase, which is what the Treasury Secretary, Scott Bessent, is aiming for when we're talking about the increase in oil production. Do you think, is that achievable to get 3 million more barrels a day out of the United States?
Look, there are two things that are going to drive increased production in the United States. One is supply and demand. And our members are going to continue to step up to meet the demands of the American people at the right price. But the second thing that we have more control over, and that this administration has more control over, is the regulatory environment. We saw a regulatory barrage under the Biden administration. We're just now recovering from that, and we expect a much more favorable regulatory environment from the Trump administration.
What about, though, on tariffs, right? That is not necessarily something that has been welcomed by the industry, right? In particular, we're looking at oil coming down from Canada to be refined into gasoline that could potentially result in higher gasoline prices in the U.S. for some folks. How are you guys reacting to that, managing around it?
This is an industry that has benefited from free and fair trade, particularly with Canada. And you're right. The way it works right now is that we import a lot of Canadian crude from Canada at a 20% discount, by the way. We get that crude at a discount for American consumers, and then it's refined in American refineries, the most sophisticated refinery kit in the world, and again, sold at a discount to American consumers because it was bought at such a low price from the Canadian market. So this is an area where we have benefited, American consumers have benefited, and we're working with the administration right now on making sure we get our trade policy right with our neighbors. We appreciate what the president has already done, which is to lower that headline number from 25%, a 25% tariff on Canadian crude to 10%, but we want to keep working with them to get it down to zero, and we're confident we'll be able to do that over time.
What does over time mean, Mike? How long do you think it's going to take to get the administration to zero on that already existing exemption, as you mentioned?
Yeah, so they've continued to extend that deadline, and we're going to work with them over the next couple of months to make sure that that deadline, that we have it to zero, because it is American consumers that benefit greatly from that free trade with Canada and our other trading partners as well.
So, Mike, I'm curious, between that back and forth with the administration on tariffs, they are at 10% from Canada and Mexico still, and some of the other dynamics that we've been talking about. Where do you see gasoline prices specifically for consumers looking out, say, 6 months from now or looking to the end of the year, given some of these dynamics that we're talking about?
Well, look, that's all going to depend on supply and demand. And obviously, if you're cutting supply from other countries, that's not going to be good for payment at the pump for most Americans. So we produce a lot of oil here in the United States. Unfortunately, because we haven't built a refinery in the United States since 1977, that was a much different oil market that we were refining oil in at that point, where we were importing a lot of oil into the United States and production was going down. The situation that we have now is that we have abundant resources here in the United States, mainly because of technological advancements by the oil and gas industry. So we have the supply here. We need to continue to invest in our refinery kit, and we invest billions of dollars in that refinery kit every single year to update it, to make sure that we're becoming more efficient, more technologically capable with the oil that we have both in the United States and we get from our trading partners. But it really does depend on those supply and demand fundamentals, and that's what we're going to be watching over the course of the next few months.
Mike, really appreciate your time. Thank you so much.
Great to be with you, Julie.
Thanks. Stick around. We got much more Asking for Trends still to come.
The tech-heavy NASDAQ closing down more than 700 points, highlighting a broader market sell-off. Our chart of the day looks specifically at the Magnificent Seven, which has cooled off since its post-election rally. Yahoo Finance's Julie Hyman joins us now with a closer look. Julie.
Yes, Tesla within the Magnificent Seven wiping out its post-election gain as of today, but it is not alone. Some of the others have been in that negative space for quite a while, in fact. So this looks at the Magnificent Seven since the election. This dotted line here is the zero line. So when they're below it, that means that they have lost percentage-wise since the election. Tesla has sort of gained the most and then now down the most since the election in terms of the round trip it's taken. It's off about 11-12% since November 5th. Of course, it was seen as a potential beneficiary of Elon Musk's closeness with the president, and now it is being seen potentially as a casualty of that closeness, as we've seen some of the sales hit. NVIDIA has been pretty consistently below for a while here. That's the lowest line here. And then you also have a couple of the others here, Google in particular, moving below at this point, and Amazon as well. The two that have held on to some of the gains since the election have been Meta as well as Apple, still holding on to the gains. So we'll see if they can continue to do so. We earlier talked to Gil Luria of D.A. Davidson, who covers some of these tech stocks, about what has been going on with these names.
Broadly speaking, for most of the mega caps, their earnings visibility is pretty good. It's better than most, but they have been trading at a very big premium based on that. And if the global visibility into the economy is now a little murkier, the market is just less willing to give high multiples on anything, even companies with good earnings visibility. So they're still good stocks. Now they're just trading closer to their historical multiple range as opposed to a big premium, which was the case even a few weeks ago.
So people are not willing to pay up for these names any longer. In particular, Luria said that a company like Microsoft or like Amazon, he thinks should be a little bit more recession resistant if in fact it came to that, or perhaps slowdown resistant. So we'll have to see if we get a bounce from some of these levels, Josh.
All right. Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.